Welcome to Alternative Investing. I'm Andrew Bell here with my co-host, David Kaufman, president of Westcourt Capital. Great to see you again, David.
Great to be here.
On this show, we explore investment concepts outside of the traditional realms of stocks and bonds. It's for investors like you, maybe sitting on cash, looking for alternative places to put your money, places not in the public markets, but in funds or products that fly a little more under the radar. And on today's show, we are going to talk about what investors need to know about risks when it comes to alternative investments, or any investment for that matter. David, give us a quick primer on risk.
Sure. Risk falls under many categories, but the four sort of major categories that I would want to identify. The first is systemic, which some people call systematic risk, which is a macro risk, so a market risk. A good example would be the stock market, because most investors find themselves at least partially invested in the stock market. The idea that the market is the tide and the investor or the securities is the boat, and that where the boat is relative to the shore has a lot more to do with the tide than it does with the boat, and so that you expose yourself to that risk no matter where you are in that market. The second risk actually falls under more of a micro concept, which is a sector risk or a security-specific risk. So a sector risk means I love financials, I'm heavily invested in financials. Something can happen where all the financial stocks can go up and down more or less in tandem. That would be bad for you if you were long, if they were to go down, for example. And then there's security-specific risk, that maybe you picked the wrong stocks. So that would be the opposite of the macro risk we talked about. The third would be advisor risk, which is a concentration concept, which is that if you concentrate all your eggs into one basket and you pick the wrong advisor, you would expose yourself to the risk of just bad picking and bad advice. And the final would be inflation risk, which often goes along with interest rate risk, because you often see the two at the same time, that if inflation were to go up, that the real return of any of your other investments would go down. In other words, the spending power of the money that you have would decrease. And so those are the risks that you would find in any atmosphere, whether you're talking about traditional investing or alternative investing.
We kind of forget about inflation, but it has decimated people in the past.
In the past, it certainly has. But we look back and we think, wouldn't we love to buy a bond that pays 17 or 18% today? And then you forget that the real buying power of that might go down over time if you're in an inflationary environment.
What products, strategies have been used to mitigate risk?
Yeah, the first, for the idea of the systemic risk, the first thing that you do is you say, okay, well, I'm not going to have all my eggs in one basket in a macro sense. I'm not going to have all my eggs in the stock market, wherever that may be. And so that you can address that with asset class diversification, principal protected notes and seg funds, which are basically securities or groups of securities wrapped in an insurance blanket, which you pay for, but it gives you insurance against the downside. And then as you move along, you can protect yourself from sector or security risk, often by buying mutual funds and using them as your friends. So it provides diversification among securities within a sector or among different sectors at the same time. You can address it that way. Really, it's the concept of diversification that we're addressing here. An advisor risk you can deal with in a couple of ways. The first is you can diversify among advisors by having more than one, especially if you have a high net worth, a lot of investable assets. You can also take some of that responsibility on your own shoulders. Don't just pick an advisor because your friend says that they're okay and they went to high school with them. Pick an advisor after you've done significant research, checked out references, etc. And finally, with inflation, there are really two ways to deal with inflation. The first would be if you wanted to be certain about it, you could buy a real return bond, which is a bond that has a fixed coupon, fixed interest rate, plus whatever inflation is, measured with CPI. And the only issue with that, of course, is that, like everything else, you pay for it, and it can mute your returns. And then the other way to hedge against inflation traditionally has been to buy gold, because traditionally gold rises and falls in lockstep with inflation, although, as you know, that's not necessarily what we've seen in the recent past.
No, we've got low inflation apparently right now, but very high gold prices.
And that can happen.
Tell us about what people are using in the area of alternative investing to get around these risks.
Usually what you'll hear about is hedging. And hedging is another way of talking about reducing or mitigating risk rather than, you're certainly not trying to eliminate risk. The only way to eliminate risk would be a perfect hedge where you bet on red and you bet on black and you're guaranteed to win one and lose one.
Unless it goes to zero, but anyway, that's the roulette analogy anyway.
In which case it's even worse.
Okay.
Zero can be the fees on that one, okay? So that you lose, you win and then you lose, and you're net zero, and it can't be a zero-sum game. It has to be a positive-sum game. And so hedging is used as a way to flatten out the curve to achieve absolute returns in any market, and it's the idea of the tortoise versus the hare. You'll hit a lot fewer home runs, but a lot more singles and doubles. And finally, what you find is people diversifying out of correlated asset classes into uncorrelated asset classes, which we'll talk about after the break. So it's not good enough necessarily to say I'm in stocks and bonds and cash. You start to introduce entire other asset classes, such as real estate or private equity, into the play. And then once those are in play alongside the others, if you've done it well, you'll find yourself much less correlated, and you can again even out the ride, be a little less nauseated from that roller coaster.
We've got to take a break. Coming up, alternative investing continues with more on how investors can mitigate risk when putting their money in different places. We're going to get advice on how to avoid the pitfalls with Craig Machel, Associate Portfolio Manager, Macquarie Wealth Management. Welcome back to Alternative Investing. I'm here with David Kaufman, President of Westcourt Capital. Great to have you here again, David. Today we are talking about mitigating risks when it comes to your investments. Let's get some expert advice on how to cut through the jungle of risk out there. With David and me now in the studio, Craig Machel. He's an Associate Portfolio Manager at Macquarie Private Wealth. It's great to see you.
Pleasure to be here, Andy. Thanks. Thanks, David.
Tell us a bit about your job. How do you spend your day?
My day, in the context of risk, is helping clients make smart decisions with their money in an effort to get ahead and provide lifestyle and choices for the future. And that's all, along the way and throughout the experience. It's all about, in my mind, reducing risks and getting ahead.
And that's the number one thing with your clients, I guess.
I think it is.
Losing their money.
Absolutely, I think it is. It's one thing to sort of, seek out returns and, look through, past history and all that kind of thing, and say, wow, that's done really well, returns are great, let's jump on the back of that. But the element of risk in capital markets is always going to be there. It's an uncertainty that's always there, and in fact, we're actually able to make some money in that uncertainty.
Dealing with risk, mitigating risk. Before the break, we talked about the traditional avenues that are used, and we hear about certainly a lot of people watching probably own seg funds. Some of them own principal protected notes.
Right.
Is that something that you, especially as a high net worth advisor, would recommend to your clients?
It's nothing that I really recommend to clients. I understand where that comes from, the notion of protecting from risks and keeping capital intact. We can all well understand where that idea would come from. But no, I'm more interested in getting better value and better results, while protecting capital along the way with just, ultimately better outcomes.
If someone came and said, okay, the only thing that matters is that 10 years from today I want to know that I'm not going to have less money. Is that someone for whom like a seg fund would make sense? Or it's still too expensive?
Again, in the context of value, and remember, you're paying fees in terms of advisory services and wealth management services. You got to understand where the value is. And personally, David, I just don't see a lot of value in those particular strategies. Rarely have I seen a circumstance where it fits.
So obviously the old cliche, well, I'm sure it's true that it's the asset class you pick, not the security. Is the asset class the important thing? So tell us about how asset allocation, how you handle that.
Asset allocation is critical. I'm a huge believer in it. What I will say is I don't think the traditional method, I think one of the biggest risks that investors face is relying on traditional conventional methods in an effort to protect from capital. Investors have been through 100-year storms twice in the last decade, seeing equity markets get cut in half.
I guess they're really 8-year storms now.
That's exactly right. It's a new term, isn't it? So it's been really rough. We've seen that happen, and I don't think that volatility and that uncertainty will go away. So all that said, to me, it's all about innovation and finding opportunities within the equity markets, bond markets, capital markets, and actually pulling gains out of them rather than simply tracking along and taking on that market risk.
Okay, but is there evidence over the long run that whether it's traditional hedge funds or other alternative strategies, is there actual evidence that employing those strategies actually does reduce risk in times of extreme turbulence?
Absolutely. We've got I think we're going to put a graph up here in a second. But if you take a look at what's called the Hennessy Hedge Fund Index, it's a broad-based hedge fund index showing up here against the S&P 500. So you can see the S&P falling in the blue, 15 worst months of decline over 22 years, versus in the red, the hedge fund index. Not only did it lose substantially less, you've also got a chance of making money in January of 2009. So yes, to answer your question, there's evidence there that this stuff works.
What we're not showing here, of course, are the 15 best months during the same period of time. And so I'm presuming that if you're going to be muted on the downside, you're going to be muted on the upside.
Well, it's a great question, actually. It's a really good question. If you actually take that chart or take the graph and project it out over the 22 years, you actually find that the hedge fund index actually posted about 14% return, compounded on average, versus the S&P index, which did about 7%. So, you've doubled your money with less risk along the way.
So that's what people would refer to as the upper left quadrant of the risk-return
That's exactly
profile.
right. That's exactly right.
So less risk, more return.
That's exactly right.
But there's okay, so if someone comes into your office tomorrow and says, okay, listen, I'm ready to start with the new asset allocation. I want to make the 14% you just mentioned. Let's go. Is that really...
No, I wouldn't ever suggest that we're just going to go and press play and go. But, over a long enough period of time, and, I want to sort of quantify here that it's important to have a long-term view of it all. But remember that protecting capital in the short term is really, really critical to getting you down that long-term track.
Let's focus in on equities. How specifically do you reduce risk? Is it taking profits?
No, good question. I mean, if perhaps I can define the classic long-short hedge fund, and that was built by a gentleman named Alfred Jones back in the late 40s. And really what he realized is that taking on the market risk it's a pretty unproductive way to go. It's harrowing. You can spend a lot of mental capital trying to get it done. And so what he did for wealthy investors is he realized that he could, with more tools in the bag and with greater stock picking abilities, not having to track an index, which is what most mutual funds tend to do, he built the first sort of long-short hedge fund, which came up with fantastic results with much, substantially reduced risk along the way. And that's where we are today. In today's world, Canadians are catching on to this and buying, understanding this in a much better way.
So traditional long-short, you're going long, you're buying your favorites, and you're selling short the dogs.
Or the opposites.
And that's still, let's remember that still, of course, involves what we refer to in the business as alpha. It still involves expertise, and there is stock picking involved in that. So
absolutely.
That brings us back to the notion that you're not eliminating the risk. What you're doing is you're using the shorts as a defensive posturing position.
Right.
Is that right?
That's exactly right.
And does that work as well today as it did in the late 40s?
It's worked throughout the entire piece based on the premise, and you said it earlier. What we're after here is good companies with good fundamentals for the future at a reasonable stock valuation. That's really important. And then short in an effort to capitalize on those companies that are too highly priced with a bit of a murky future.
I bet there's a number of people watching who are sitting there thinking, wait a minute, I lived through 2008. I owned hedge funds in 2008, and they were not my friend. So what was it about those hedge funds and those hedge fund managers that was different than, say, the original Alfred Jones approach?
I think you really need to ask yourself and ask your advisor and ask your hedge fund guy, were you hedged? Were you hedged through 2008? Were you hedged through 2009, or are you going to be hedged today? What's the hedging policy? Or is it more of a bet, which is really the sensational side of the story, and the elephant in the room, is the hedge funds that do fantastic results but can't sustain it when times get tough. And that is well and truly not a hedge fund.
I guess there's a natural human inclination to look for things that go up. Is it hard for people to kind of bet against stocks?
No, I mean, you raise a good point. I mean, the whole premise here is to reduce risk, but we're still aiming to move the meter forward, right? So betting against stocks is just... Again, if it's always in place, we don't know, we don't have the crystal ball to understand when the markets will fall apart or what the effect that Greece might have on us or China or what have you. But if you have those shorts constantly in place, not only do you have an ability to protect capital, but you actually have an ability to make it. When those stocks fall.
Do you find a lot of managers, especially in what I understand are less efficient markets like Canada, saying we're going to go long on specific equities and then we're going to hedge by shorting the index rather than trying to pick individual shorts? Is that popular?
Yeah, some guys will do that. And really, if you break that down, if you look at the mechanics of that, I mean, the index is a fairly silly index here in Canada. It's composed of 75% financials, materials, and energy. So yeah, you can reduce that beta exposure through the index.
And still, we find ourselves in the end measuring against that index, and in the end, people will say, "Did you beat it or didn't you beat it?" And it's certainly problematic.
Right.
Got to take a break. More with Craig Machel after this. We're going to be talking about some of the risks you may face if you're thinking of sticking with cash or fixed income. We'll be right back. Welcome back to Alternative Investing. I'm here with David Kaufman of Westcourt Capital, and we've been talking about mitigating risk with your investments. Our special guest this half hour, Craig Machel, Associate Portfolio Manager, Macquarie Private Wealth. It's great to have you here.
Great to be here, thanks.
The big institutions are obsessed, obviously, with reducing risk. What have they been doing that regular investors can learn from?
Well, there's a few investors out there, and pensions are actually moving more towards a thesis and sort of a way to go about this by way of a gentleman named David Swensen. And David Swensen has taken over the Yale Endowment Fund, the Yale University Endowment Fund in the U.S. about 25 years ago. And really what he did is he turned conventional wisdom and portfolio theory on its head, threw it out the window and said we're going to go about it in a much different way, both in an effort to reduce risk along the way, protect from the short-term losses, and move the meter forward as time goes on. And so what he's done is two things I find really interesting. The first is absolute return strategies, which are premised to drive 8 to 10% per year returns, irrespective of what markets do. He's got about a 25% allocation to that sort of strategy, which is primarily what we're talking about so far today. The other side that's really interesting is traditional equity, whether it's domestic, foreign, and bond strategies makes up only 30% of that entire foundation's capital. So it's a really different, innovative way to go about it, and the returns have been fantastic. So that's in the pension fund world, but that type of application can work with private clients, individuals, corporations, and so on.
But before we move on, let's make sure of one thing, that running a pension fund, endowment fund, or foundation does not make a manager a genius.
Very true.
A genius manager can do very well with that size of capital, but the converse has clearly not been the case, because in 2008 we saw a lot of, especially the pension funds, some very large ones in Canada that took enormous hits. And some people are costing their jobs, isn't that right?
It has. And I think the premise there is to really understand, and you could argue that some of these gentlemen or some of these people behind these funds weren't really clear as to what they were investing in. And then when liquidity crunches hit, that's where the going gets tough, so to speak. So you're entirely right, David.
But let's get exotic. Let's talk about some of the more advanced alternatives to just straight equity investing.
Right. I mean, there's a few different ways to go about it. Why don't we'll pull up a couple of examples here. Credit arbitrage. Something outside of the equity world into the fixed income world. Credit arbitrage, a good example, is an Air Canada bond long. We're going to collect the coupon on a long Air Canada bond, just for instance. And then short the Air Canada bond with a different coupon. We're going to give back that coupon, collect the coupon on the other side, and really keep that spread between the two of them. Also, what you're doing is eliminating the risk of the underlying credit or the underlying company, in this case, Air Canada.
Okay, so you've eliminated the risk of the underlying security, in that case, Air Canada in your example. And when you hear about arbitrage, let's understand that. So arbitrage, the way I understand it, is identifying through an inefficient market an opportunity that either may exist at a very small moment in time, like you see with certain kind of currency arbitrage, or over an extended period of time. But the idea is that it's finite. So it requires, does it not, a tactical approach to where it is that you're applying those assets at a given time?
You're exactly right. I think that's really the essence of what we're doing here, primarily in the alternative asset space, is being tactical and seeking out opportunities, understanding, too, where we can protect from risks, and tactically, moving in and out of these different markets and different opportunities.
And we hear about merger arbitrage a lot, which is still uses arbitrage, but in a very different way. Can you explain that to us?
Much different way. A good example there is in the fall we saw Kinross Gold take over Redback Mining. And typically what happens, the target company, in this case Redback, typically what happens is that stock price will move up higher towards the acquisition date. So there's an ability to go long there on the stock and make some money. And then conversely, in terms of the purchaser, Kinross in this example, oftentimes, not always, but oftentimes the stock will actually fall. You put a short on Kinross in this case, and there's an ability to make some capital there.
And once again, because we've said all along, we're not eliminating risk, we're mitigating risk. In a case like that, I suppose that the company that is the target of the acquisition, I mean, if it doesn't close, they can go plummeting back to their sort of pre-premium price.
There's your Potash example.
And so you can certainly suffer in that. What about, we've talked about managed futures on this show quite a bit over the last couple of months. Can you discuss how that fits into the concept of
really solid
exotic?
diversifier. Great strategy in terms of capitalizing on directional price trends in various different types of commodities. So a few different examples there that we've seen over the course of the year, and there's been money to be made here. The Australian dollar has risen up, in fact, through parity with the U.S. dollar. It's had a phenomenal run. So that direction's been in place to make some capital on it. Natural gas has fallen. So there's a position which has fallen up until recently about 40% over the course of the year. Capital's been made there, and gold and silver and metals and such. So you combine all that into a managed futures strategy, and really where you're going to be thankful for that strategy is in times like 2008. And the managed future guys who were on the game were up 15, 20, 25% when the rest of individual portfolios were typically falling. So there's your value right there. And if you think about what was happening there in terms of mechanics, equity markets are falling, energy markets, metals markets were all falling. There's sustained trends in place. And likewise, bonds and currencies were perhaps rising. So a great diversifier in that sense.
Typically, when we want to talk about how much risk there is, we talk about volatility. And when I hear futures, options, I think leverage, and I think volatility. So how does the managed futures approach deal with the idea that I'm not just going to get on a wild seesaw?
First of all, it's important to understand there's actually not a great deal of capital involved in managed futures strategies. And there's no leverage inherent within it. There's no borrowing within it. So we're not at risk of that. And then secondly, that can be a volatile strategy. You can see some volatility along the way. But historically, volatility, and again, one of the premises of the alternative investment space is actually capitalizing and winning on the back of volatility. So rather than running from it and being fearful of it, there's actually an ability where we're actually to be able to make some money there.
So so credit arbitrage, merger arbitrage, managed futures, it all sounds great. But at the end of the day, when you turn on the TV and you see the ticker, you don't see that. And so what I'm wondering, and you have a lot of clients that are in some of these various strategies. At the end of the day, when that's what they see, how do they measure their results? Against what benchmark would they measure their results? Do they say, well,
Great question.
the TSX was up this year and we were not up as much, so that I don't think we're doing a good job?
Great question, and I think, in terms of educating clients, and I'm really happy we have these shows, and there's better education getting out there to investors. The premise is you've worked hard to earn your money, work hard to keep it, and work hard to grow it. Tracking the index is fraught with all kinds of risks. We talk about the components of the TSX, but the premise is, if we're tracking along at 8 to 10% per year, that's good. We'll give up those big returns knowing that we've got capital well protected in place.
We're going to have to leave it there. Thanks very much, Craig.
Great to be here. Thanks.
Craig Machel of Macquarie Private Wealth, and of course David Kaufman of Westcourt Capital. We are out of time on alternative investing. We love to hear from you. If you've got a question about alternative investments, email us at alternativeinvesting@bnn.ca. Thanks very much for watching. Season's greeting from all of us here at the show. Have a great time, everybody. And, of course, we'll be around in 2011.